Today, we will talk about the dividend yield. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. The reciprocal of the dividend yield is the total dividends paid/net income, which is the dividend payout ratio. The dividend yield is an estimate of the dividend-only return of a stock investment. Assuming the dividend is not raised or lowered, the yield will rise when the price of the stock falls. And conversely, it will fall when the price of the stock rises. Because dividend yields change relative to the stock price, it can often look unusually high for stocks that are falling in value quickly. New companies that are relatively small, but still growing quickly, may pay a lower average dividend than mature companies in the same sectors. In general, mature companies that aren't growing very quickly pay the highest dividend yields. In some cases, the dividend yield may not provide that much information about what kind of dividend the company pays. For example, the average dividend yield in the market is very high amongst real estate investment trusts. However, those are the yields from ordinary dividends, which are different than qualified dividends in that the former is taxed as regular income while the latter is taxed as capital gains. Along with REITs, master limited partnerships, MLPs, and business development companies, BDCs, typically have very high dividend yields. The structure of these companies is such that the U.S. Treasury requires them to pass on the majority of their income to their shareholders. This is referred to as a pass-through process, and it means that the company doesn't have to pay income taxes on profits that it distributes as dividends. However, the shareholder has to treat the dividend payments as ordinary income and pay taxes on them. Dividends from these types of companies, MLPs and BDCs, do not qualify for capital gains tax treatment. The formula for dividend yield is dividend yield equals annual dividends per share/price per share. The dividend yield can be calculated from the last full year's financial report or by adding the last 4 quarters of dividends. Because dividends are paid quarterly, many investors will take the last quarterly dividend, multiply it by 4, and use the product as the annual dividend for the yield calculation. Finally, some companies pay a dividend more frequently than quarterly. When deciding how to calculate the dividend yield, an investor should look at the history of dividend payments to decide which method will give the most accurate results. Historical evidence suggests that a focus on dividends may amplify returns rather than slow them down. For example, according to analysts at Hartford Funds, since 1970, 84% of the total returns from the S&P 500 are from dividends. This assumption is based on the fact that investors are likely to reinvest their dividends back into the S&P 500, which then compounds their ability to earn more dividends in the future. While high dividend yields are attractive, it's possible they may be at the expense of the potential growth of the company. It can be assumed that every dollar a company is paying in dividends to its shareholders is a dollar that the company is not reinvesting to grow and generate more capital gains. It's not recommended that investors evaluate a stock based on its dividend yield alone. Investors should exercise caution when evaluating a company that looks distressed and has a higher than average dividend yield. The dividend yield tells you what the simple rate of return is in the form of cash dividends to shareholders. However, the dividend payout ratio represents how much of a company's net earnings are paid out as dividends. Many believe the dividend payout ratio is a better indicator of a company's ability to distribute dividends consistently in the future. Suppose Company A's stock is trading at $20 and pays annual dividends of $1 per share to its shareholders. Suppose that Company B's stock is trading at $40 and also pays an annual dividend of $1 per share. This means Company A's dividend yield is 5%, while Company B's dividend yield is only 2.5%, $1/$40. An investor looking to use their portfolio to supplement their income would likely prefer Company A over Company B because it has double the dividend yield. The dividend yield is a financial ratio that tells you the percentage of a company's share price that it pays out in dividends each year. If a company's dividend yield has been steadily increasing, This could be because they are increasing their dividend, because their share price is declining, or both. Depending on the circumstances, this may be seen as either a positive or a negative sign by investors. The dividend yield of their portfolio could have a meaningful effect on the personal finances of some investors, making it very important for these investors to select dividend-paying companies with long track records and clear financial strength. For other investors, dividend yield may be less significant, such as for younger investors who are more interested in growth companies. Yield-oriented investors will generally look for companies that offer high dividend yields, but it is important to dig deeper in order to understand the circumstances leading to the high yield. One approach taken by investors is to focus on companies that have a long track record of maintaining or raising their dividends, while also verifying that those companies have the underlying financial strength to continue paying dividends well into the future. This will depend on the time frame you look at. Dividend yields change daily as the prices of shares that pay dividends rise or fall. Some stocks with very high dividend yields may be the result of a recent downturn in share price, and oftentimes that dividend will be slashed or eliminated by the managers if the stock price does not soon recover. Many stocks pay dividends to reward their shareholders and to signal sound financial footing to the investing public. The dividend yield is a measure of how high a company's dividends are relative to its share price. High-yielding dividend stocks can be a good buy for some value investors, but may also signal that a stock's share price has recently fallen by quite a bit, making the legacy dividend comparatively higher in relation to the share price. A high dividend yield could also suggest that a company is distributing too much profits as dividends rather than investing in growth opportunities or new projects. Here are 5 key takeaways. 1. The dividend yield, displayed as a percentage, is the amount of money a company pays shareholders for owning a share of its stock divided by its current stock price. 2. Mature companies are the most likely to pay dividends. 3. Companies in the utility and consumer staple industries often have relatively higher dividend yields. 4. Real estate investment trusts, REITs, master limited partnerships, MLPs, and business development companies, BDCs, pay higher than average dividends. However, the dividends from these companies are taxed at a higher rate. 5. It's important for investors to keep in mind that higher dividend yields do not always indicate attractive investment opportunities because the dividend yield of a stock may be elevated as a result of a declining stock price. Hope this would help. Thanks for watching.